Hi, my name is Jeremiah Lane. I am a partner at KKR and a portfolio manager of KKC, here to provide you an update on some recent announcement we made about KKC, an update on the portfolio and the opportunity that we see ahead. We announced that for fiscal year 2024, we will be increasing the distribution to a rate of 20 cents per annum, an increase of 52% from the rate that we were distributing for fiscal year 2023. The new rate represents 8.6% of NTA and 10.8% of the unit price. As of May 31st, the current yield on our portfolio sits at 10.2%, and we've got a yield to maturity of 12.6%. So importantly, we think that the new higher distribution rate is sustainable with the portfolio that we've been able to build. We also announced that we were ceasing our share repurchase, our buyback, that's been in place for the last period of time. In total, we've repurchased 100 million Aussie dollars of KKC units at the prevailing discount that was available in the market. We think that the portfolio that we have today offers a compelling return, and that returning interest proceeds to investors through regular distributions is more favorable than using some of those excess interest proceeds for repurchasing in the open market. We continue to be focused on collapsing the discount to NTA that persists in the traded price of KKC, and we continue to discuss with the responsible entity the opportunity to pursue different strategies to achieve that objective. As a reminder about KKC, there are a number of elements of this fund when we created it in 2019 that continue to be true today. KKC provides a single entry point to KKR's traded and private credit strategies. We've married our opportunistic credit strategy, which is our flagship traded credit strategy. It's a global strategy, with our European direct lending private credit strategy to give investors some income diversification. These are both institutional strategies. These are strategies that we use to introduce ourselves to some of the largest institutions in the world. This is a one-stop shop for Australian investors to gain access to these strategies. And we think that with the portfolio that we've built today, we'll get into some more details later, but there's also substantial upside, both in terms of the distributions that we'll deliver to investors going forward, as well as potentially NTA appreciation. In the KKC structure, we provide daily liquidity available on the ASX, income diversification across the asset classes and across the geography, downside protection, which we've been able to show in these strategies over a long period of time, and as I said, potential upside from where things are trading today. Focusing in on performance this year has been strong. Using the NTA and dividend distributions, we've achieved a 7.7% year-to-date performance. That's 12/31 through the most recent reading at the end of May. Using the KKC traded share price, because the traded price has lagged while we've been able to achieve an NTA, we've achieved a 2.4% return. Looking back over the last year, the NTA plus the dividend distributions have appreciated by 6.3%. Attractive performance versus what's been available in the 50/50 loan bond index that we reference ourselves against. We recognize that the NTA, as you can see on the left-hand side, has been volatile. Obviously, with COVID, it sold off substantially, traded at a very big discount to NTA. We were ultimately able to recapture the NTA that we initially issued at, achieving 2.5 NTA during 2021. In 2022, the market sold off again, and with it, this portfolio, and we've begun the process of recapturing those declines as we trade through this year. As a reminder for folks, the KKC portfolio began as a fully traded portfolio with the intention of migrating into European direct lending as we identified loans to make in the market and funded those loans. So at inception, we were 100% traded credit. And then fast forward to today, we're about 60% traded credit, 40% European direct lending, in line with the objective that we set when we initially offered KKC to investors in 2019. So it's been a long road. The opportunity to make those private loans was for a period of time more limited as a result of COVID. There was less borrowing activity. It's perhaps taken us a little bit longer than we anticipated that it would, but we have achieved the portfolio composition that we initially set out for investors as our objective. Looking more deeply at the portfolio snapshot, we've had a slide like this slide in most of our prior communications with investors. The punchline is really that the portfolio that we've built is very consistent with the portfolio that we set to build when we were initially on the road in 2019. I already spoke about the asset class and geographic diversification, very much in line, a little bit more than 50% in the US, a little bit less than 50% in Europe, a little bit more than 50% in traded credit, a little bit less than 50% in private credit. We've got strong ratings exposure. The reason for the large unrated portion of the portfolio is that typically private credit loans are not rated by S&P and Moody's, those third-party rating agencies. Very much in line with our expectation. Capital structure exposure, again, in line with expectation. About 2/3 of the portfolio invested in senior secured. Everything on the private credit side is senior secured. And then on the traded credit side, you have a mix of senior secured, unsecured, and other types of securities. I would also highlight in the portfolio statistics section that we see an opportunity for substantial appreciation of our portfolio from where it sits today, focusing specifically on that average weighted price. Today, it's 91 cents on the dollar. We believe that the portfolio that we have will recover to par, or in some cases, actually even above par over time, as some of those lower coupon assets that were created before the significant reset in the rate environment are pulled apart as they approach maturity. So we've already seen a nice recovery from the disruption that we saw last year. We think that there's more recovery available if we continue to be successful in picking good credits. Finally, I'll just leave with some comments on what we're seeing in the market and the opportunity set that's out there. Punchline is that we believe the market opportunity is very, very attractive. Focusing in specifically on the yields available in the broad market, you can see in that middle section, U.S. high yield currently yields 8.5%. If you look at the rightmost column, on a 10-year basis, that's the 10th percentile. Only 10% of the days over the last 10 years have you been able to get more than 8.5% yield in high yield. Most of those days were moments of significant disruption. That was the period of the energy-related sell-off in 15-16, the period of the COVID-related sell-off in early 2020, and for a period of time after that. It's very unusual that you've been able to get this type of yield with an economy that's running at 3.5% unemployment and generally fundamentals coming through from companies that are reasonably strong. Similarly, on the bank loan side, where we have floating rate exposure and a portfolio that is still also trading nicely below par, today you can get 10.5% yield in bank loans. And if you look at that over the last 10 years, that's the second percentile. Only 2% of the days have you been able to get more yield than what's available today in bank loans. It's this market opportunity that gives us conviction that we're going to be able to sustain this much higher dividend distribution rate that we've just announced for KKC shareholders for fiscal year 2024. So with that, I'll conclude. Thank you to all of you who have been invested in KKC For those of you that are interested in KKC, thank you for your interest. We continue to be very focused on this product. We think that the strong recent performance can be sustained, and that there is a substantial opportunity for further upside ahead, both as the underlying assets that we're invested in continue to perform, and hopefully we will be successful in closing that gap to NTA that's persistent. Thank you.